Good morning, all. Thank you very much, Rashmi, and thanks for all the viewers for joining in the webinar. I'm Muntaz Bimji, the Associate Director, and I'll be speaking on the job support scheme and the self-assessment income support scheme as well. So with the job support scheme, it kind of replaces the CJRS, which was the coronavirus job retention scheme, and where employees who are being put on furlough, the government was contributing 80%, which then reduced to 70%, and starting from this month has now reduced to 60%. So just as a reminder, that scheme ends at the end of this month. And there are discussions amongst people that yes, the CGRS scheme will be extended, and there are pressures on the government to extend the scheme. However, the scheme will end at the end of this month, which is then being replaced by JSSS, which is the job support scheme. So the government has understood that, okay, businesses are opening up. However, the demand is low. So they need to put in some sort of support, some sort of measures so that the employers can bring back the employees and kind of still pay them and be able to do some sort of transactions and get the demand up and running. So if you move on to the next slide, please. So what does the scheme entail? So the government is going to top up for the wages for the hours that have not been worked, and we'll get into the more details of it. So any employee who is on a short-time working arrangement will be eligible for that scheme. It is open to all businesses, especially small and medium-sized enterprises. It's also open to large businesses as well. However, large businesses will need to pass some sort of financial assessment test, which they need to then demonstrate that, okay, their revenue has been impacted with the COVID-19 conditions and continues to be impacted. And if they then decide to claim under this scheme, then they'll need to demonstrate that they have not made any capital distributions such as dividends or share buybacks. This scheme kicks in from 1st of November 2020, and it will be there for the next 6 months until the end of April 2021. If we move on, next slide. Yes. So in here, what exactly happens? So this is the confusion bit, and it can get very confusing if you don't really understand it properly. So I'll just try and split this into two. So one is where the employee is working, and the other element is the employee's non-working hours. So this scheme will be eligible if the employee is working at least a minimum of 33%. So I'll just give an example. An employee is working for 5 days and is being paid £350 for the week, which equates to around £70 a day. And in this case, let's say the employee works 2 days a week. So and I'll build onto this example going forward. So just to keep it easy and simple. So if the employee is working 2 days a week, that equates to around £140 for those 2 days. So that cost will be paid by the employer. So the employer will be responsible for that 2 days, as well as the NI and the pension contributions. And the remaining 3 days that the employee didn't work, as far as he worked a minimum of 33% of his usual hours, which he did, then the government will contribute 1/3 of the non-working hours. The employer will have to top up another 1/3, and the remaining 1/3 will be kind of missed income or lost income or foregone income by the employee. So in this example, the employee would have received £140 for the 2 days he worked, and then the £210 which he for the non-working hours, the government will contribute 1/3, which will be £70. The employer will have to top up another 1/3, which will be another £70, and the remaining 1/3 will be foregone. So the employee in total will receive around £280 for that week. And just a reminder, the government's 1/3 contribution is capped at a maximum of £697.92 per month. If you move on to the next slide, please. Next slide, please. So in terms of redundancies and top-ups, so if an employer then decides to make an employee redundant or put them on notice of redundancies, then they cannot claim under the scheme. So just bear in mind, if you are claiming and using the scheme, then no redundancies or notice pay for redundancies can be covered as part of the grant. And what do we mean that the pay cannot be topped up by the employees? Uh, in if you all recall, within the furlough scheme, there was this 80% grant initially from the government, and then the 20% remaining was encouraged that the employers can top up and pay that to the employee. However, in this scheme, if the for the non-working hours, the two-third contribution by the employer and the government, on top of that, the remaining lost income for the employee cannot be topped up by the employer. So the example I used previously, we said that the employee earned £280 of the 350. That remaining £70, the employer cannot top up even if they so wish to, but they can just not do that. If we move on to the next slide. Um, yeah. So in effect, how much does the employee earn then? So if the employee is working a minimum of 33%, they will they will end up earning 77% of the usual wage. Um, the more the employee works, is the less hourly contribution made by the employer. We'll probably find out more in the next slide, which is got a tabular format. Um, Under this scheme, you can claim for both the JSS as well as the retention bonus. So looking at this table here, so it demonstrates on the far left column on employee working a minimum of 33%. And it shows that the employee will not be working 67% of the time because obviously he's working 33%. However, the total earnings for the employee, despite only working 33%, will be 78% of the normal wage. The government contribution, the one-third contribution is the 22%, and the employee contributes 55%. And then as we move along the columns on the table, we can see if the employee works, say, more than 33% and work 40%, 50, 60, and so on, and how the variations amount to the employee's earnings and the employer's contributions. If you please move on to the next slide. So a reminder on the job retention bonus scheme. So as mentioned previously, those employers using the JSS support scheme can also still use the retention bonus. This was announced way back in July 2020, where an employee who had been previously furloughed and has then been retained from November onwards up until the end of January 2021, the employer will be eligible to receive £1,000 grant per employee. Obviously, there is a condition that that employee must earn an average of £520 per month across the 3 months. So it does not necessarily have to be £520 each month, but on an average for those 3 months, it should amount to more than or an average of £520. In terms of how you can make the claim on the retention bonus, not much details have been provided, but we do understand that at the end of January or beginning of February, you should be able to go in the gov.uk website and be able to make the necessary claims. Um, so that's on the job support scheme. Move on to the self-employment income support scheme, which builds on from the previous scheme, which was announced, and that has not really changed in terms of the eligibility. So those self-employed individuals and members of partnerships who are eligible in the previous claims. So there were 2 previous claims made. So if you have made claims and have received your grant, then you will automatically be eligible for the next 2 rounds, which is the first period is from November to January, and the second one is from Feb to April. So the one for November to January, the self-employed individuals will be entitled to 20% of their average monthly profit, which is capped at 1,875. So fairly similar to the JSS amounts announced by the government. However, for the following round from February till April, no further announcements have been made in terms of how much percentages will the government be contributing, because I think they're still waiting on how the economy is picking up before they decide in terms of numbers of percentage. In terms of application, so the payments will be made in arrears. So end of January, beginning Feb. Again, if you have been eligible, you should receive a link, and then you should be able to go in the link and make the claim. What are the eligibility criteria? So if we go into the next slide, so we've got the details of the eligibility criteria in there. And it's not really changed from previously, as I mentioned. So if you were previously entitled for the SEISS, then you would automatically be eligible now. However, you need to ensure that you have continued trading in the 2019-20 tax year, as well as you intend to carry on trading from 2020 and 2021. And from the previous criteria, which was that your trading profits should be £50,000 or less, and at least half of it should be from your self-employment income. And how they determine the income element is they look at your trading profits for 2018-19, and if you don't meet that, then they'll also look at the average of the last 3 years tax returns. So any of those conditions, if you meet, then you'll be eligible for the grant. And I think that's it for myself. Thank you.
Thank you very much, Muntazir. Just to give you some information from my side, I can't see the screen at all. I can hear you guys. My screen has gone a complete blank. So as I said, I can't see anything. So when we come to the Q&A, I may have a bit of difficulty and I may require help, but we go to it at that point. So now I'll pass you over to David, who will take us through the helping businesses, the bounce back loans and the tax deferrals, as well as the VAT. So David, over to you. Hello.
So perhaps I should just press on and start talking about the loans and the grants, because as Rashmi explained at the beginning, I'm going to cover that section. And these are the other types of support that were introduced when COVID struck back in March. So I'm going to start with the bounce back loans, or BBLS. And I'll give you a quick retrospect of what qualifies you for the BBLS, and then explain to you what changes the Chancellor has made in his winter economy statement. So we move on to the next slide. So just as a reminder, business bounce back loans were available between £2,000 and £5,000 in support, capped at 25% of a business's turnover. And that business had to be impacted by COVID, but that was on a self-certification basis. Not a business that was thought to be in difficulty before the end of December 2019, trading within the UK and established before the 1st of March 2020, not using any other support schemes such as CBILS, which I will talk to you about next, not in bankruptcy or liquidation, and at least 50% of their income had to come from trading, which is a similar requirement to the requirement in the self-employed income support scheme that Muntazir just explained. And also there were some restricted sectors such as banking, insurance, public sector bodies and state-funded schools, but those are unlikely to affect clients of Macalvins. So What was the basis of these loans? Well, they were loans, as I've said, of up to £50,000 with only a 2.5% interest rate. I say only, but that is very advantageous. And the other big advantage with these loans was that the government gave the banks backing for the loans, and the banks are not allowed to ask you for personal guarantees or to pledge any of your personal assets in connection with these loans, which obviously makes them very advantageous. Now, the deadline for businesses to apply was originally the end of September, and extension has been announced in this winter economy statement to the end of November, the 30th of November. So if you did miss the boat, and if you think that you meet the eligibility criteria, you now can apply in October or November for one of these business bounce back loans. They're managed through a sort of umbrella organisation that the government set up for such support schemes called the British Business Bank. So the detail, and I think a lot of detail that you will need, and links to where you make application, are on the British Business Bank website. So do have a look at the British Business Bank website. It also tells you which banks are members of the scheme and have signed up to offer business bounce back loans. Now, originally, when these loans were introduced, the payback period was going to be 5 years. The first 12 months, you didn't have to make any repayments at all. And then over the following 5 years, you were expected to repay the loans. And there wasn't going to be any cost associated with taking the loan, and no interest in the first 12-month period. That was covered by the government. What Mr. Sunak has announced now is that he's extended the repayment period, so that if you've taken a business bounce back loan, or if you're considering doing so and you now have the next 2 months in which to do this, you will have a 10-year repayment period at the end of that first year. So that will, as it says on the slide, potentially halve your monthly repayments under the loan scheme, which again makes it even more attractive than it was. An additional option is that you can move to interest-only repayments for up to a 3 to 6 month period, or you can choose to take at any time during the repayment period, whether it's 5 years or 10 years, you can take a 6 month payment holiday at your request. But that will only be available to businesses that have already made at least 6 payments under the scheme. Okay, moving on now to the other loan schemes that were available. First of all, I'm going to mention CBILS. These were the larger loans, so loans that come above the £50,000 limit. Eligibility for these was similar to the bounce back loan schemes. You had to be a UK-based business with your business activity in the UK. You had to have a borrowing proposal for a CBILS loan that a lender, a bank, would consider viable were it not for the COVID pandemic. So because these are larger loans, the banks are allowed to apply their normal lending criteria in deciding whether or not to offer these advances. And you could also, again, self-certify, and needed to self-certify in the application that your business has been affected by COVID. That's a bar that I've always thought is set extremely low, because it's hard to imagine any business that cannot say, hand on heart, that they've suffered some impact from the COVID crisis. There's also a mention here in the note, the second note, about the future fund, which I'll talk about later. But in essence, the future fund is, again, it's a larger loan fund, and it's to do with innovation. So it's businesses that work in the fields of innovation, because the government don't want innovation to be halted or stopped by COVID. They are prepared to make loans to businesses that can satisfy the criteria that they work in the field of innovation. And again, here with the CBILS loans and the larger CLBILS loans, the period for application has been extended to the end of November. So if you feel that you can qualify for a CBILS loan, you now have the next 2 months in which to make application. The bar is a lot higher, I can tell you, for the CBILS loans than it is for the Business Bounce Back Loan Scheme. The Business Bounce Back Loan Scheme is an online application. If you're applying to your existing bank, it's a 2 or 3 pager, and the applications seem to be being dealt with very rapidly, and the monies are made available very quickly. A CBILS application is much more like a traditional lending application, and you will be required to submit lots of additional information, such as accounts, cash flows, business plans, and so on, as you would expect for a larger loan. But once again, it's supported by the government, which means that the banks are effectively underwritten and are more likely to look favourably than under normal trading conditions. Okay. The Treasury have also said in the statement that a new successor loan programme is set to begin in January, but of course we don't have details of that. We'll bring those to you as soon as we know. And the Bank of England's corporate finance facility will remain open, we've been told, until the 22nd of March 2021. Okay, so that's what I wanted to say to you about the loan schemes. Now we're moving on to the third plank, if you like, of the government support schemes, which is measures that were designed to help with directly help with cash flow. And we're going to start with the extended tax deferrals. So if we can just move on to the next slide. You're probably all aware of these, but I'll just go through them again briefly. You have been, as a VAT registered business, permitted under the COVID measures to defer any VAT payments that were due between March and June 2020, originally until March of next year. And here again, there's an extension here to the amount of credit being allowed, because Mr. Sunak announced that you will now have the option to spread the deferred amount, that's the amount that you haven't paid them for any returns that fell in that period, in 11 instalments you can make payment over the whole of the 2021-22 financial year. So that effectively any VAT that you've deferred under this scheme will now not be finally paid if you choose this option until March of 2022, when the last 11th will need to be paid. But there is a requirement here that you have to opt in. In other words, if you don't make it clear to HMRC that you want to take this option, you'll be expected to make your catch-up payments by March of 2021. Now, there were similar arrangements, you're probably aware, in respect of self-assessment tax payments, which were due at the end of July this year. The government said they are not necessarily to be paid by the end of July, although if you want to, you can. Obviously, they're never going to reject payment, but they've automatically deferred the requirement to pay until January of 2021. Initially, that was what was being offered. Now, they've now extended that deferral for those with up to £30,000 of liabilities, and said that if you fall within that category, you will be able to arrange under the existing what's called time to pay facility, which is the HMRC scheme allowing instalment payments of tax. You will be able to ask them to arrange a 12-month repayment plan of the tax that you deferred in July this year. So again, rather similarly to the VAT deferral, this is allowing an extra 12 months of payment time for, in this case, income tax that you've chosen to defer. And the deferral that came in July, those of you who may have received statements from HMRC of amounts. I've just lost, okay, we're back in the room. Automatically on those statements, HMRC had moved the payment date to 31st of January 2021. Some of our clients have taken the option of deferral, and some have chosen to make payments so that they're not storing up a bigger liability for January. But that's obviously entirely up to you and will depend on your particular cash flow situation. But this is welcome because these deferred amounts effectively now have another 12 months of deferment. Okay, final thing under this item, the extended VAT cut for tourism and hospitality. We're all well aware that the hospitality sector has been very badly affected by COVID, probably the sector that suffered the most. And because of that, the government introduced a lower rate of VAT for certain supplies associated with the hospitality and tourism sector, mainly to do with the provision of food and non-alcoholic beverages, and also there was some application if you did hot takeaway food and non-alcoholic drinks for takeout. They've now agreed to extend this temporary 5% rate of VAT for such qualifying goods and services through until March 2021, after which the rate they have said will revert to 20%. There's some very complex rules about what qualifies here. So if you think, but you're not sure that you have qualifying supplies, by all means contact your contact at Macalvins and give us your specific circumstances, and we will try to advise you whether or not we think you do qualify. Because obviously if you claim this 5% and get it wrong, the consequences could be quite expensive. Okay, the final thing I wanted to mention is briefly just to go through some other financial support measures for businesses which are still ongoing. Now on the next slide we mention at the top there business rates relief, and with that I would couple the small business grant fund monies. I mentioned this in the first webinar that we did on COVID support, which is that businesses that qualify as small in terms of their rateable value, this is obviously businesses that have commercial property interests that qualify here, but the businesses that qualify as small, where their rateable value is less than 15,000 or between 15,000 and 51,000, there have been grants available at rates of £10,000 or £25,000 through your local authority. If you haven't received notice from the local authority that you're eligible for this and you think you might be, please do contact them, because I don't think it's guaranteed that they will necessarily have notified everyone who's eligible of their right to claim this. These, of course, are grants, which gives them a great advantage over the loans that we've just been talking about, because they're not repayable at all, although they're taxable, and we may talk a little bit more about that later. So businesses in the retail, hospitality and leisure sectors do also qualify for business rate relief, and many, if not all of those businesses, should be paying no rates in the 2020 to 2021 tax year. If you are still paying rates and you believe you fit into this category, do contact your local authority and do try to claim the relief. We know of circumstances where businesses do operate in these sectors, but because the classification on their rates bill doesn't seem to indicate that they're in this sector, the local authority are not granting the relief. And in one particular case like this, we made representations with our client and the relief was eventually granted. So just because you haven't been notified of eligibility, if you do believe that you fit into the retail, hospitality and leisure sectors, do contact your local authority, try to claim this relief because it is very valuable. Now, the local authority have also been given a discretionary grants fund for small and micro businesses. So if you are a small business, and again, the categorization is to do with whether your rateable value exceeds 51,000. If you're below that, you are, for this purpose, a small business. Then they have discretionary grants available. So this would be where businesses perhaps don't fit the retail, hospitality and leisure sector, but have been very badly impacted by COVID. You can make an application for a discretionary grant from your local authority, provided you haven't made claims under any other government scheme, as it says here, other than the job retention scheme, which doesn't disqualify you from applying for a discretionary grant. Now, the clue's in the name with these. Of course, the local authority have discretion on whether or not to make a grant out of this fund. But if you feel you've been very seriously impacted, this would be a good place to start to look for assistance. Now, if we move on to the next slide, I just want to briefly mention the local lockdown grants. Now, we're all aware that there are local restrictions being imposed by the government where there are spikes in coronavirus cases. And along with that, they have announced that there will be local grants available in those, just in those specific areas, up to £1,500 on a 3-weekly basis. And again, if you are operating at all in an area that's subject to local lockdown restrictions, do bear this in mind. But businesses which are still closed because of the national restrictions, such as nightclubs, which we mention here, unfortunately won't be eligible because they're deemed to have to be closed because of the national restriction and not the local one. And I briefly did mention this future fund earlier on, and I'll mention it again here. There are convertible loans between £125,000 to £5 million available from this future fund to companies which can meet the criteria that they're working in the areas of innovation. And the applications again on this one, again dealt with through the British Business Bank, have been extended in line with the other loan schemes to the 30th of November 2020. And two small but important support measures on the next slide, which will finish what I have to say to you, is the Kickstart Job Scheme, which is still available and continues to be available. So if you're a business that employs young adults between 16 and 24 years of age who are in receipt of universal credit, at risk of long-term unemployment, you can receive funding to cover the entire cost of their salaries at national minimum wage level for 25 hours of work per week over a 6-month long work placement. Again, this is a measure whereby the government are trying to help young adults get into work in spite of the crisis problems. And on a similar vein, there is what's called the apprenticeships bonus. So from August 2020 till next January, any company that hires a new young apprentice, so that would have to be on an apprenticeship contract, who is between the same ages as the Kickstart Job Scheme, 16 to 24, can receive a £2,000 bonus. While if you hire new apprentices that are over 25, there is still a bonus available, but it's just at the rate of £1,500. So these are two measures, again, as I said, which are still in existence and are to help you employing young adults during the coronavirus crisis. Thank you. I think we can move on to any Q&A that might be necessary, and I'll pass you back to Rashmi.
Thank you very much, David. That was really good. I mean, there's a lot to take in, but yeah, the support's out there and you summarize it really, really well. So moving on to questions and answers. Now I can see my screen, thank God. There is one question, but where people want to raise any other questions, please look at the icon at the bottom of your screen and you can then raise any questions that you wish. I will start with the question that's there. The question is, for the JSS scheme, will we be required to pay NI and pension contributions on the government contribution? So that's one for you, Muntazir, please.
Mm-hmm.
Yeah. So in terms of the scheme and how it works is obviously you will be paying the employee all of the wages that they are entitled for, and when you claim for the grant, you will receive the 1/3 of the hours that are not worked by the employee, but that is only for the wages, and so that does not include the NI and pension. So in simplicity, the employer is responsible for paying the pension and NI for all the hours worked and all the hours that are non-worked as well.
Okay, so you gross up the value that the government is giving you and then base the NI and pension contribution calculation on that.
Yeah, so the employee will be paid normally for the hours that they are working and whatever grant that they are entitled for. But when we claim back the grant from the government, we will get a maximum of say £697 per month. But that is really just covering the gross wages, not the NI and the pension.
Okay, so the employer has to top that up, right? Just
Yeah.
so silly question this may be, but why has the government chosen a specific number like 697.92 as the maximum? Any ideas?
Not 100% on why that number is,
Yeah.
but it seems like it is trying to give at least an employee to get a minimum or an amount of 78% of their overall wage if they work for a minimum of 33%, um, if they work for a minimum of 33% of the usual hours. And this kind of ties in with the self-employment income support that they are providing, which cost around is 1,875. So they want to try and balance it out between this support scheme as well as the support scheme on the for the employers.
For the self-employed. Okay, thanks. And just one other follow-up. Can employees come on and off the job support scheme?
Yes, so they can cycle on and off, provided the minimum term of claim is at least for 7 days. So whatever arrangements are, the short-time working arrangements, say it's going to be for first week be 30 hours or 20 hours, then it has to be at least for minimum of 7 days. And the best practice is to make sure that any such arrangements are discussed, written down, agreed by the employer and employee, because if there are any future checks by HMRC, they will definitely be digging on the reports. And given that there have been some fraudulent claims in the CJRS scheme, then the government are clamping down more on these claims. And in fact, they have said that any claims made within this scheme, the employee will be informed of that. So the employer, if they try to do any fraud or anything, the employee will find out because they will be getting information on what claims are being made by the employer.
Okay, thanks, Muntazir, for that. We have one other question coming out. The question is that their 33% of 7 days question, or 7 whole days that they need to work?
So that 33% is for the usual working hours. So let's say an employee's usual working hours are 5 days a week or 35 hours a week. That would equate to around 12 hours a week. So it's that. And 7 days is that if you make an arrangement, then that should last for 7 working days.
Okay, so it's based on number of hours, the employee has to work 33% of that
A
to be
minimum.
eligible.
Yeah. They can work more than 33%, but to be eligible for the scheme, the minimum.
Okay. Hopefully that answers the questions, but if there are any further follow-ups that you require, obviously you can ask them now or send them to us. Muntazir@macalvins.com, David@macalvins.com, or myself, Rashmi@macalvins.com.